It's Thursday, July 8th, 2021. And today we've got a very special episode for you where Alex and I are going to be talking about the key questions facing the Canadian tech ecosystem in the second half of 2021, including, is this the end of easy money? How bad is the tech talent shortage? And what trends will accelerate or reverse as vaccination rates rise and Canada reopens? And stick around until the very end because we're also going to be doing some lightning fast quick takes on breaking news like Fightcamp's raise, Ritual's acquisition, and Softbank entering Canada with an investment in Clearco. Let's get started. First question. For the next 6 months of 2021, Alex, is this the end of easy money?
Well, maybe we should define what's happening and what easy money is.
Let's do it. Tell me about how easy money has been in the first half of 2021.
Yeah. So first, for any founders listening, there's no such thing as easy money. Every raise is hard. But if you look at the first half of this year, we've got record numbers of money in both the public and private sector going to tech. Not only the number of money being a record amount, the valuations have been record breaking as well. So to give you some context, in the first half of the year, in the venture capital market, and I know these are underreported numbers, there's been about $7 billion invested in Canadian startups. Now, comparison's sakes, in 2019, which is a record number, there was $7.9 billion invested. So in the first 6 months, we're almost at a record already for VC investing. There's been 20 investments over 100 million, 10 new unicorns that I know of, and then in the public markets, we've had 8.4 billion raised on a TSX and a TSX venture exchange. And this is compared to a record of 8.1 billion in 2020. So we've already raised more in a half a year publicly than in 2020, which was the last record breaking. And over the last 12 months, there's been 14 tech IPOs in Canada. And that's without talking about, this is just Canada. We're not talking about the States because there's been periods before where the States has money being thrown around and Canada's slow, but even in Canada, it's really good right now.
And are these CVCA numbers, Alex?
The first quarter was CVCA and the second quarter was estimates I've seen by like the Globe and Mail, which I think they get from CVCA.
Okay. And just for some context, if you are new to the Canadian tech scene, Alex and I have been doing this since 2013. Have we ever seen any kind of activity or numbers like this in the last 8 years?
Well, you haven't seen it. Well, in 2019, you saw 7.9 billion over the whole year. But again, two things: you've never seen this much so quickly, and you've never seen these valuations. Like if you go back 18 months, there was a bunch of articles going around saying, "Oh, Canada never produces companies worth over $100 million." You know, like we used to celebrate companies that became, had an exit of $100 million. And again, there's 20 companies that raised over $100 million in the last 6 months.
Okay, but now, Alex, that's where you like to tell me about back in your day when you were working the public markets down in New York in the 2000s. What happened does this remind you at all of a frothy market before the dot-com boom back then?
Yes and no. I think what's changed fundamentally over the last 20 years is I think there's been a lot more. Tech is huge. Tech is everything. And so some stuff that we consider tech maybe aren't tech. Is DTC tech? I don't know, but it gets put in the venture bucket. And what you've seen over the last decade is a lot of small spikes and booms, right? And busts. Mm-hmm. So if you go back 10 years ago, you had Groupon, you had Gilt Group, you had e-commerce, and then that went up in valuation. Everyone could raise money, and they went down. Then you had VR and AR. You had the ICOs. So the underlying market has been a lot more fickle and exchange and ups and downs. But
the overall trend, though, has been sort of up.
The overall trend, and there's some reasons behind that. One is, go back to 2000, there was X number, 20, 30 million people using the internet. Now everyone has a smartphone. Like it's rare to see someone that's not connected. Mm-hmm. Interest rates are incredibly low, and so that's a big difference, right? You were talking about 6 or 7% interest rate versus 1% interest rate. Mm-hmm. Just naturally, if you use math, valuation should be higher. There's record amounts of money raised being looked to deploy. Which makes me feel a bit like 2000, because when money doesn't know where to go, it starts paying too much, and when money disappears, it goes down quickly. So mm-hmm. there is a sense that the valuations are ahead of where they should be because money's searching for a place. And I think the other thing which is happening here, which is similar to 2000, wins beget wins, and they don't have to be real wins. So like, hey, I invested in Amazon that's gone up 10 times in a year since it's gone public. Oh, well, I should go invest in pets.com and I should go invest in, you get less discretionary where you put your capital because you think you know better than the market. And then all of a sudden Amazon goes down 90% and then you don't want to, so like
you're overfitting your pattern recognition.
And you're confident. When you feel confident, you know, so some similarities, some differences.
So let's talk about some of the beneficiaries in the first half of this year. Who are some of the mega deals that stand out to you in the world of easy money so far?
Well, again, not saying they got easy money, but people that stand out that got a lot of money is Fair, Apply Board, Clearco, and that's just here. You go to the West Coast, there's Trulio. It's basically anyone that got $1 billion valuation, and I think those are the ones that seem easy money. The ones that I'm less sure about is the ones that have raised $20 million. Like look at Dooley, they raised what $60 million in 6 months. Again, I don't know their numbers. I don't know if their valuations are, if that's easy money, if it's just people had FOMO and they want to get into that deal, right? Like those are the ones that are probably the ones that either companies are just absolutely killing it, or what I've seen in this market, which I haven't seen 2-3 years ago, is I talk to VCs in the Valley. They go, look, if I see an A round, I missed out on it, I think it's a company I want to invest in, I'll go and talk to them the next week and offer them twice the valuation. And I believe we've seen some of those deals here. It's just hard from the outside because they may not be announced. We don't know the numbers. So Dooley might have benefited from something like that. Okay,
but tell me a little bit about why we think it could be the end. Like what's changed, you think, where it's not going to continue here, this funding gravy train?
So there's what I see changing and then what could change. So let's say why. So I talked to lots of venture capitalists and everyone talks about deal fatigue. And that just means, hey, everyone says, I'm supposed to invest in 4 deals a year. I've invested in 3 and it's May. Right. And I'm tired. I want to go out. I'm vaxxed, I'm waxed. I'm going out to Miami.
It's August.
It's August. Yeah. So I think there's some deal fatigue, but I think I'm skeptical about that because VCs, if they see the deal, it's their job to invest. I think the second thing is, which seems like a bit of a red herring to me, is like you've had a few IPOs fail and the market's been a bit, and usually what people say, it's, the founders go out and say, hey, it's IPO fatigue. But the flip side is you've seen some companies succeed. So I think you're seeing a bit more discretionary approach to the market. I think the other thing which I've seen, which might portray weakness, is in crypto. So a lot of the early funding and is from crypto winners. And when Bitcoin's at 50,000 US versus 30, what I don't know, was it 25,000 US, 30,000 US? People have a lot more discretionary income, and then those wins go into other places, right? So they trade out of Bitcoin, they go buy Ethereum. Ethereum runs up, they go buy shitcoins. The shitcoins go up, and they're like, okay, now I buy NFTs, or I go buy, I bought friends starting companies, and I 10 million valuation or 20 million, who cares? So there's a bit of fatigue in the market. The other thing is there a rising inflation? If inflation rises and the market in interest rates rise, everyone that does finance as a living will change the valuations, which will push pressure down. And also then usually when there's rising inflation, people trade out of growth stocks to value investments. What's the protection of my asset value? So those could happen. And then our retail, the other thing is there's been a few, in the States, there hasn't been many IPO bombs. If you look, the IPO market's performing really well for tech. In Canada, I feel there's been a few stocks that have gone down. Not everything's been thinkific.
All the ones I buy, Alex.
All the IPOs you buy. So which one are you buying?
Yeah, I know.
So if retail investors get burnt, they might avoid it. And then then there's the thing we can't predict. Like what ends these is not the thing we mean you think it logically about. It's like, could China messing with Didi screw up the whole market?
Got it. So you have a lot of, I think, macro opinions here, but there's no one canary in the coal mine, like one specific micro deal that you think is signaling the end of the sort of the bull run that we've seen these first 6 months.
If the one that I thought would be it, and the market seems to be resilient right now, is the SPAC deals that are complete frauds, or sorry, don't want to get sued, that look like they traded off misinformation. So and those are more in states like Lordstown. Okay. And I think, and we haven't seen normal IPOs have bad numbers. Maybe it had been overvalued. So right now everything looks good, but so did everything in 2021 until one day it didn't, and then another day it didn't. Sorry, 2001. Yeah.
And here we are 20 years later. All right. So as at the end of the easy money, what do you think? I know there's no such thing as easy money, but does the funding continue, rise, go down, stay the same, or go up in the next 6 months, Alex?
Well, let's talk about what happens if it goes down. What does it mean? So because we haven't talked about that. If it cools off, teams, you'll see the implication of a cool market, I think, is not going to be as drastic as it was 2001 for this ecosystem. Teams with money
Mhm.
will be more focused, and Me Too companies will not be funded, and the people will focus more on controlled growth. Think of what Uber's had to do since they've gone public. Uber was growing at all, what means they've now sold off. The stock for Uber cooled off. So what did they do? They sold the big cash negative businesses and focused on the core business, making the numbers go right.
Yeah, it becomes an execution risk versus a financing
Yeah,
risk.
and then this actually helps the companies, all the unicorns, that raise shitload of money, if they haven't burned through it, are in a much better position than the companies that haven't raised. But so, and the question you asked is, I think the market will cool down. I don't think you can say blistering hot, but I don't think it's going to get cold.
Got it.
What do you think?
And so if you're in the market for funding right now, whether you're early stage or in a growth stage, should you be hitting the fundraising circuit?
I've been I've been saying this for years, because you can't predict when the market will turn, but when it'll turn, it'll make it harder to raise. So any founders that have a good enough story that's emerging, go raise now. Always better to have a bit of money in your pocket than find out it's harder to raise.
Okay, let's move on to the second question. How bad is the tech talent shortage right now? So first, let's talk about the shortage. What shortage do you see out here?
Every position. Come on, you get the emails.
Well, what emails? Tell me. Describe the emails that you're getting.
So, hey, okay, one of the companies that raised, I get this often from founders I know. Alex, can we get on the phone? Okay, I haven't heard from the person in a year and a half. Hey, Alex, we just raised $10 million or $20 million. We need to find 30 people by next week. Or another one that says, we have 100 people now. We want to hire 500 people by August 31st.
And are these people doing it? Are they achieving their goals?
I don't know. Well, is Amazon? Look, Shopify's looking for 2,000 people. Amazon said they're looking for 1,500 people in Toronto. These are the ones that are public out there. Like, everyone's moving to Canada. What you must get emails like this.
I get emails from all sides. I mean, I think the number one email I get is from people trying to help you navigate the talent shortage. So recruiters, freelancer, brokers, all sorts of stuff. I mean, those are pretty fast to spam.
And again, it's not just developers, it's salespeople, marketing people, like, to build the whole business.
Yeah. You know what slowed down though, Alex, was recruiters asking me if I want a job. That's gone. Maybe now I'm fully unemployable, which is great.
It's that head behind you. That's what makes you unemployable. It scares people.
That's right. No, but yes, everybody that I know is looking to hire, and everybody has open positions. So, do we have any sense of like how big the shortage is, or how big the gap is, or how many jobs are open?
Everything I read is generic reports like, hey, there's going to be a worldwide shortage of developers of like by 8 million people in 2025. I see Natalie, who's listening to us, is laughing at this comment. It's just a lot. It's a lot. Look, if we go look at the open positions in the Canadian rocket ship list, put together, I think there's 4,000 or 5,000 open roles there in 30 companies. Like, look, we had Andrew on yesterday, and he was hiring 300-400 people. Right.
And that was that before he talked about that new raise, or after?
Well, they seem to put a more focus on international expansion, so I think that was before.
Yeah, amazing. Very cool. So what do you think? Thousands, I mean, just from the TechTO rocket ships companies at techto.org/rocket ships, thousands of open roles in those 30 companies. Is this going to continue? Like, are we just at sort of an imbalance in the market? It's a motion opportunity. People are moving, and then we're sort of going to settle in equilibrium, or is something out of whack here, and there needs to be some sort of external solution?
Well, I think there's a structural problem in the economy. Like, honestly, now I'm going to get political. I would have loved to see during COVID times some benefit paid for people to learn about sales, learn about marketing, learn about programming. There's just these jobs and the skills are needed. There's a mismatch in the market. And also lots of these companies want to hire someone with 2-3 years experience. So even if you go to more like a boot camp, unless you go to the biggest company who can take you in and train you further, no startup wants you. And I think that we're seeing this is why it's so bad right now. Is you got the post-COVID tailwinds, and you've got all this funding coming in. So like, companies are staying alive, they have money to deploy, and then everyone else is digitizing. Like, you took 10 years of digitization and pulled it 1 year forward. So every big corporation needs it too. And it's like, I think it's a structural problem. And then what the flip side is, once you get outside of tech, the rest of the economy, there's going to be so many people that are unemployable because they don't have the skill sets that are needed. So I think there's a fundamental problem.
Right. There's a retraining opportunity as well.
Yeah. And
Yeah.
there's retraining, and I guess so. Yeah, let's invest in ed tech or training tech.
Yeah.
And I think the biggest reason it will not, the pressure will get released is one of three reasons. One
Mhm.
is if you believe the distributed workforce is here to stay, companies will start hiring outside of Canada. Like I'll go to India, I'll go to the Philippines, I'll go to Spain, Ukraine,
Sure.
and hire developers, maybe marketers, maybe not salespeople. The economy slows down or funding dries up, but it's until so if the economy slows down, either none of those solutions are good. If the job, like if these jobs could be held in Canada and be going to pay in Canada, and
Mhm.
now it's going to India, it's good for India, it's good for the world, but it's not good for us.
Interesting. So if you are part of the TechTO community, is this something that should keep you up at night? And I guess, is there an opportunity in there for you?
Well, so if I'm looking for a job and I've got the experience, I'm gonna damn well negotiate my fair share. Like I think you're gonna see the startups. Unfortunately, with all the funding, it's just gonna go to tradition goes to three people: landlords, Google, and Facebook, and employees. And I think now it's gonna go more to employees because landlords are gonna have some pressure, and Google and Facebook, not everyone needs them. So if I'm an employee, it's a good time. If I'm not happy where I am, I have the skill set to go see what I can get in the market.
Yeah.
If I don't have those skill sets, it's worth investing and I think also building a portfolio showing you can do it. So I think it's never been easier to find another opportunity. As an employer, you have to think about how do you recruit and retain the talent. And I think, yes, one way is you have to pay your market share and you should pay what's fair. But is there something about the mission? Is there some roles that you don't need? Should you be outsourcing something, right? What you have to think creatively about how you build a team. What is your core competencies? What are you doing in house? And then how do you create a package that recruits employees and retains employees you want? It could be flexible work hours to recruit parents. It could be, I don't know. What's the perk at Wealthsimple that got you to stay there so long?
It's a bundle of perks, but I think
Yeah.
I think you've got it right, which is it's not just the compensation. I think especially for top talent, I don't think they're moving over just dollar signs. I think there's a package of benefits which include the people you work with, the culture that it represents, the kind of values that you stand for, how work gets done, the opportunities to build something meaningful and big. And I think employers are going to have to go a lot. They're going to have to start with the salary and compensation and go well beyond it in order to attract the kind of talent that they want, which I think is great.
Like, look, going back to you asking about the bubble, I remember in 2001 being in San Francisco, going to the cinema, and there was employers advertising, if you could introduce a developer hire, we'll give you a BMW.
Yeah.
So again, I don't think that's a good strategy, but it was a strategy that someone's trying.
Amazing. Okay, let's do one last question for the back half of 2021. What trends do you think are going to accelerate or reverse as vaccination rates rise and Canada reopens?
Jason, I saw an interesting question. Can we get that question first from the audience and then come back to this?
Yeah, it's Renee asks, what would be the best way to hire diverse talent?
Yeah. So let me think about that. Like, I think it's creating a diverse culture. Like having a bunch of white 40-year-old males as your team makes it hard to hire, just because, like, especially for startups, they go and hire from their network. They have the predisposition. It's easier to sell there. So like, let's go to example, AngelList. At one point, in the AngelList Ventures team, we had a few engineers that were all younger male. And we talked about saying the women wouldn't come in and interview with us, and they would not take us seriously. So we actually made a purposeful effort to make sure the next 4 hires were all women, and it became a lot more easy because they had their networks. They could, also when an employee has the ability to see who's at the table, they can see that they're accepted. So I think, again, I'm not an expert in this, but I think it's just right away consciously hiring a diverse group to start with, and then I think it's also finding out where to reach out to people that may not, that shows that you value them. So like, I wish we had Sage here to talk a bit about this as well, but what has Wealthsimple done, or what have you seen tried, Jason?
Yeah, hey, I think that's a great idea for an episode. Why don't we bring Sage up and talk about people who are working on this all the time? I think it's the community wants it. Renee wants to know. I think it's awesome. Yeah. Cool. You ready to move on?
Yeah.
All right. So first, I know this is probably like old news, but what are the biggest changes you have seen over the last 16 months? Like, what changed quickly And then what changed sort of slowly since we've gone into the COVID world?
So the stuff that have been positive, and they're not all related to COVID, just happens to be timing. We'll start what we just talked about, focus on diversity and inclusivity. Much more emphasis on that.
Yeah.
And this is, again, not necessarily COVID, but climate tech, especially because if you lived in California, all you do is live through wildfires now. Remote distributed work has benefited. Health tech, and then, which doesn't get talked as much as it should, is lots of consumer-related companies have benefited. Fintech, fitness apps, education, e-commerce. They've all had a huge spike. Flip. Again, this is not huge analysis here. Suffering is travel, live events, commercial real estate, prop tech. So
okay, so the usual suspects. But now I think the interesting question is, as we emerge from it, which losers become winners, which winners become losers, and what stays the same?
Where do you want to start? Do you want to stay with the ones that
first? Let's start with the winners who are going to stay winners.
Okay, so I think the clear strong winners are ESG related. So that's clean tech, governance, diversity, inclusivity. Those are ones that had tailwinds before. They had acceleration of tailwinds due to Black Lives Matter, the forest fire. So it was related to COVID because they had more attention on it.
Sure,
but they already had, people were already worried, and the concern for it, and of all are all definitely stuff that are going to get more time spent on it. Health tech, I think there's been a shortage of talent, nurses and doctors, and lots of governments realize the regulations they put in place don't make sense. So there might be lots of regulation change. So that opens up a lot of opportunity. I think most people will still want to do a remote visit for the first time to a doctor now. And then I think some of the entertainment, e-commerce, and consumer fintech they're simply, people found them and they're simply better options. It's better to use an app than going to a branch. And I think they'll have strong winners. See, now Lee's saying ed tech. We'll get to that in a second. What do you think the most prominent ones are going to stay?
I think we have different. Let's go through your losers first. I think I've got a different perspective than you. So let's talk about losers today, or let's talk about losers today who are going to become winners. So I think there's some obvious ones in there, but I'm curious to hear what you think.
I think travel's going to come back. I think it's going to come back faster than people expect. It'll be different. Live events, but not fully. I think there's a certain sub of the live event that's dead, and I think parts of education will reverse. I think stuff like that Disco's doing will continue. Let's learn from creators. Let's do stuff. But I think a lot of stuff from K to 12 will reverse because homeschooling fucking sucks. God bless the parents that can do it. But at least how it was done in Ontario, and at least what I've talked to people in a few others, live in other states, everyone wants to get their kids back in school. Yeah,
boarding school. I'm investing in boarding schools now. That's what okay, so let me talk about I think the most interesting one are winners today that you think are going to be losers as this reopens.
I think we'll slow down. I don't think they'll necessarily reverse. I think, the creator economy, less time to watch and make. And I think there's I'm starting to read a lot about creator burnout. Experience consumer apps. So again, this is kind of what I say with fitness, but fitness, mingling online, food delivery, people will want to use them, but the growth will slow down as people want to get out and socialize.
They'll have options.
I want to go to a restaurant with my friends instead of ordering to my house. I want to get out of my house.
Question is, do your friends want to go to a restaurant with you? But let's figure that out. As
consumer prop tech, a lot of vacancies in offices and retail will be slow to recover, and they'll be repurposed. So I guess this will continue to be a loser. Then the one which I think you'll probably disagree with me the most is remote distributed work. Look, it's going to stay and there's going to be hybrid. I think it's going to slow down, and I actually think it's going to a lot of it will reverse in the short run much faster than people think.
Yeah, I think this is going to be a tale of different generations. I think that there is now an expectation in some of the younger employees that there is no reason for them to go to the office unless they want to.
Yeah, it's interesting because, I think two things. First of all, I think we live in a tech bubble and we live with around younger people. And anyone I talk to outside of tech, they want to go back. They believe to go back to office. I was I did a virtual coffee with a few of my friends, and one's in U of T, and he's been going throughout the whole thing. He's a professor there. Another is like head of legal for insurance firm. They said, they're going all back. Like everyone else outside tech seems to be going back.
Yeah.
And what amazes me though about the younger generation that says that like they don't understand the benefits of being in person. Like, why do I want to go to a big city early in my career? I get to meet people outside of my job because there's a society. Like, and I guess it's a generational difference. I guess you could meet people on Discord. You can meet people on Twitter.
If you think even further back, people had institutions that were not their company to meet people, to find like-minded people that shared their values, had nothing to do with their company.
Yeah.
And I think that there is a world where it is inefficient for your job to go into an office to do your work. And there's lots more efficiency to hang out with the people that share similar values that are not aligned to the corporate goals, for you to meet, for you to spend time with, for you to socialize with, for you to build professional development networks with outside of your company. And those can be virtual and be anywhere in the world. They can be local and you can be with them in person tomorrow, but you just don't have the same paycheck from name on it,
Yeah. So like, I think, I think there's a different perspective. I think it's also like, look, if you believe everything can be done virtually and remotely, and it's going to be hard for companies to get companies don't like you can't monitor. Like I've actually just on a call with a startup this morning. They're now hearing from other startups. They believe 20 to 30% of developers are doing 2 full-time jobs because they're remote.
Amazing. There was a great Reddit post about the guy that does 10. You see that one?
No, I haven't. Right. So like, so I think right now, because everything happened so fast, that people are seeing all the benefits of being remote. They're not seeing the downsides.
Yeah.
And I think because employers, if they're going to go to a fully distributed thing, are going to start monitoring this shit. Like, yes, everyone says they care about output. And I think for the companies, it's going to be hard for them to build culture and retain employees. It becomes much more mercenary. So I think if this remote is, if you really believe companies can be remote, I think it's the start of the DAO. Right? Because like, to me, the reason I think a DAO doesn't work is like if you really care about the culture and the mission of the company, either the company's going to have to invest a lot in doing offsites and getting the companies together. And then that doesn't work for an audience. Like, I'm sorry, it doesn't work. Like if I were to go tell my wife, I'm going to leave 2 weeks every quarter to go meet with my company in California, it's not going to work for most people. So I think I just think I actually believe in a distributed workforce, and I think it's going to there. I think the initial next few years are going to see big kickback because it wasn't done. The tools are still not there. And I think once you start seeing people push back against, you're going to see a lot of these startups die. And it's
if only there were really robust tools to allow for companies to build culture on the distributed workforce. I agree with you, Alex. Maybe one day. But
culture is not forced getting to meetings. It's the I'm going to grab a coffee with you.
That's some parts, not all of them. I think there's a lot to be built. I think it's a huge opportunity as there's a shift. I agree. It's got to slow down because right now, for a long time, everyone was 100% forced to do it. And so, of course, there's some pent up demand for it. But I think there's been structural shifts. Don't think it's coming back. And I for sure don't see
I think it's going to boomerang.
5 days required in office is not going to be a thing.
It's not going to be in tech, but I think in most of the most of it will be.
All right, Alex. If people want to keep up to date with your predictions for the second half of 2021 and see if these questions are how these questions get answered, they've got to subscribe to the TechTO newsletter. What can subscribers expect in tomorrow's edition?
Well, tomorrow's edition, we're going to have a profile of a company called Tribe, which actually helps you build communities online. So, talking about future trends.
Amazing. And then also tomorrow at noon, July 9th, 2021, we're back with another Canadian company that you got to be watching. It's Relay Financial. Co-founder and CEO Yosef is going to be joined by Carrie, partner at Bain Capital Ventures. They're going to be talking all about the journey to the recent Series A and expanding into US markets. And then have a great weekend because on Monday evening, we're going to be back with a special healthcare edition of the TechTO Together live stream. We're going to be joined by Sharif Habib, the co-founder and CEO at Dialogue. He's going to be talking about the journey to IPO, and Andrew Aruda, the CEO at Automate Medical, who are helping medical professionals work smarter by digitizing and analyzing patient data. You excited, Alex?
Can't wait.
I mean, Monday night, we've just been scratching the surface on what's changed in the last 16 months across industries. We're going to be going deep into what's changed in healthcare. I think it is absolutely wild, the stories that are coming out there. And you're right. People weren't ready for digital doctor visits. And now it is the norm.
I think people were ready. It just the financial incentives and regulation wasn't there.
Let's talk about it on Monday night.
Okay.
All right. Next, we've got some lightning fast quick takes on Fightcamp, Ritual, and Clearco. Lightning fast, Alex. Let's start with Fightcamp.
So Montreal founded and now LA-based Fightcamp announced, they're I call them the Peloton for boxing and kickboxing. Announced a $90 million USD round from a long list of investors, including NEA and Connect Ventures, which is NEA's partnership with CAA, and some famous angels like Supercell CEO, ClearPass CEO, Usher, and a few people that might appeal to the market: Mike Tyson, Floyd Mayweather, George St. Pierre, and Francis Ngannou. I don't know if I pronounce it right.
These are all of your favorite superstars, right, Alex? I'm
a big boxer.
Yeah. So why do you care about them? Woo! All right. If you are listening on the podcast, get over to YouTube and see that one. Maybe we'll put that one in the show notes. So why do we care, Alex?
Well, this is interesting. So we think the Canadian ecosystem is really strong, but this is a company that felt compelled to leave Montreal to move to LA to scale. And they did it because they felt they had to be close to the entertainment industry. They felt they had to be close to fitness influencers. So it still shows we have a lot to do in this local ecosystem. And I love also they've built to a rather large company without much publicity. So again, they felt they need to get near influencers.
Hardware and software and media all together. They are exposed on so many fronts. This is a really hard thing to get right, and it looks like they're on a great trajectory. Looks like they're kicking it. All right, next, let's do Ritual. This is an acquisition.
Yeah, so very simple. Toronto-based food ordering and mobile pickup startup Ritual acquired. It's called All Checked In. So All Checked In is a company that serves restaurants as well. They create a QR code. So when you go into that restaurant, you can answer a questionnaire and they can use you for all the COVID related health reasons. So didn't seem not disclosed for how much this was worth. So a couple things here. Ritual had a tough year last year. Right. They've managed to be like a cockroach. They managed to be resilient. They've pivoted.
I've never used Ritual more than ever. Like I use it more than ever this last year.
For Creeds?
I use it for Creed's actually dropped Ritual, but I use it for Ezra's. I get my coffee every morning. I got it this morning again because I can't go in and order. So I might as well just have it waiting for me when I get there and pick it up from outside the window. You're
showing how resilient they've been. And now it's interesting because this is one of the areas I've seen lots of areas that are rebounding from COVID. Mm-hmm. Everyone's like, hey, I've got an idea. And I've seen literally 10 restaurant startups in the last month. And lots of them are like, oh, we have to get this QR code. And here's Ritual, who has distribution, who survived, has capital. It's like, you know what? We'll just acquire this and add these new functionality that we need.
But how big could this acquisition actually be? This has got to be small, no?
I think it's small, but to me, it was more interesting to see that, hey, Ritual has a distribution. They're going acquiring the stuff that these startups think they're going to build. I think lots of startups think there's an open space. I think this is.
I went out to a restaurant for the first time in a long time last week, and they had one. They had the QR code printed out up when you checked in, and it's just a QR code opens a type form. I just put my information in type form. I don't think this is rocket science. I'm looking on LinkedIn. It says 2 employees. It shows me 1, and it says product at Ritual.
So you want to guess what this is required for?
I think it's 1 person. Yeah. What do you think?
I don't know, $500,000, $1 million.
All right, Alex, let's pivot into the QR code takes you to type form business. No, I don't know. I think it got Curtis a job. Congratulations, Curtis.
Cool.
Let's move on.
So breaking news this morning, Softbank invested $250 million USD into Clearco. And, along with the announcement, Clearco's talking about how it's going to accelerate their global expansion and ambition. Mm-hmm. There was also a couple other new investors into it, Bow Capital and Park West. Familiar with Intuit, don't know about Capital and Park West.
That's got to be a distribution opportunity right there with Intuit, right?
Yeah, and I think my guess is without reading who both Capital and Park West is, I should have done that before. I bet you they're debt lenders that won't, that probably want to get some equity upside.
Interesting. So you think they're already participating in some of the debt vehicles that Clearco's done?
Yeah, because they just sound like.
I'm sure there's a graph that shows you like debt versus equity names. If you're forest or stone related, you belong here.
Exactly. I think I saw a startup for that. So why I found this interesting. First of all, Softbank has now entered Canada. This is their first investment here.
Wow.
And you may have heard of them. They make big bets. They swing for the fences, and these big bets, like, so usually when you make a bet, like in Series D or E, the variability of outcomes or the distribution of outcomes is relatively small. With SoftBank, it's binary as a C. They either have an amazing home run or they have WeWork. And WeWork's not even the worst. They have a Greenskill, which they've had a few that went to zero.
There was a pet one also, I think. Yeah. A couple really big blow-ups at that level that you don't typically see.
Yeah, like Greenskill, and there's a couple in England that went to zero, and you have DoorDash, which they made a huge fortune.
And this one's a winner. Come on, we know this one's a winner. Alex.
Yeah, we know this is a winner, but no. What I'm saying is, and they have not looked at Canada before, so this may change the late stage capital, environment in Canada, which on top of what we've seen already, you might just juice it up more if they're serious about this ecosystem.
To your point about what's going to happen in the back half of 2021, if SoftBank's getting ready to write more checks into Canada, well, that could definitely keep those numbers hot for the rest of the year.
Masa, TechTO will talk to Masa if you want.
Masa, that's right. One more check from them could keep it hot for the rest of the year.
Yeah, and then finally, the other thing that's interesting here is I think Clearco is really talking about being aggressive in international expansion, and I think they're going to pursue. There's two ways you've seen companies do international expansion. You have Uber, who explicitly said, we're not going to acquire any copycats and we're going to do it ourselves.
And then they did.
No, they didn't acquire stuff. They eventually sold out for the markets they were losing it. They actually did very few.
Yeah, they bought didn't they buy Kareem?
They sold their competitor to Kareem. They may have invested in Kareem, but right? They sold their competitor to Didi. They bought adjacent markets, like they bought Drizzly recently and they bought Corner Shop, but that wasn't their core business. Like their core business, they went and entered many markets really quickly and did not buy any competitors. So versus Groupon, who went and bought every clone out there. Right. And I don't think either one's perfect, but this indicates more of a Uber, like, let's go.
Well, take a look. Let's look into the leadership team here. And we know that Michelle was a beneficiary of Groupon's strategy, right? So maybe that reveals a little bit of the playbook.
Yeah, well, I think they're going to do more like Uber. You're starting to see copycats in Latin America and other places. Yeah. And when you explicitly say international expansion, and you're going to focus on it, I think they're going to take this money. And SoftBank has connections to quickly go wider and faster.
What a beautiful stage to get to, where people are raising by pitching themselves as the Clearco for Latin America, the Clearco for North Africa, the Clearco for the Middle East. Isn't that cool?
I heard someone pitch themselves as a TechTO for New York.
Oh, yeah. Oh, I love it. Wow. Okay, we just got to talk about the insider community for 1 second, Alex, because if you want to join a community of cool companies and people like Ritual, like Clearco, like Fightcamp, and you want to meet other Canadian tech founders, entrepreneurs, and investors, you got to head over to techto.org and check out the insider membership program. Alex, we are there every day answering questions, making the connections that create that beautiful fabric in the Canadian ecosystem and just helping it grow. Who have you met recently in the insider program?
Yawar Abbas, the founder of Dose. We're talking about a startup.
Yes, finally, you're connecting with Yawar. That's awesome. Dose is super cool. I'm excited for you to learn more and check it out. And what a week it has been in Canadian tech. Listen, if you haven't already, I need you to like and subscribe wherever you're watching or listening, so you can keep up to date with the latest from TechTO, and we will see you on the inside. Thank you.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea. So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.